All right, so buckle up because today we're diving into a question that's, well, it's pretty fascinating to me at least. Can your everyday shopping trip actually fuel a $1 trillion company? We're talking, well, obviously, Walmart. They're already a retail giant,
Okay.
obviously. But could they become the first dividend king to hit that? I mean, at that mind-blowing market cap. You sent us this article from The Motley Fool. It's published just yesterday, January 24th, 2025. And we're here to break it down.
Yeah, what's striking, I mean, right off the bat, is Walmart's stock performance in 2024. I mean, we're talking a nearly 72% surge, second only to Nvidia on the Dow Jones. That's not just growth. That's a, I don't even know, rocket launch.
Okay, so let's unpack what fueled this blast off. The article points to
Yeah.
have some really savvy moves by Walmart, like going all in on e-commerce. Their Walmart Plus delivery service, and even this is interesting, getting into AI. It seems like while other competitors were scrambling to keep up, Walmart was already adapting to the new landscape.
Absolutely.
Yeah.
They were really. Reading the tea leaves and acting decisively. I mean, think about it. Inflation was hitting everyone's wallets hard last year, but people still need groceries, household goods, all the essentials. And Walmart just brilliantly positioned themselves as the go-to for both the budget conscious and those willing to spend a bit more, capturing a wider market.
Yeah, it's like they managed to thread the needle, appealing to everyone from the bargain hunters to those looking for convenience. And the article really highlights how this contrasts with
Well, the struggles faced by other big players like Target and even the dollar stores. Walmart's strategy seems to have been a home run.
it was, at least in terms of the bottom line, their revenue and profits hit record highs, even surpassing pre-pandemic levels. That says a lot about their operational efficiency
Yeah.
and their ability to anticipate and meet consumer demand.
So record profits, strategic wins. It's a pretty impressive picture. But this is where things get interesting to me. The article throws out a caution. Is Walmart's stock now overvalued? The Motley Fool seems to think it might be. That's the million. Or in this case, trillion-dollar question, isn't it? Past performance is never a guarantee of future returns. We need to look beyond the headlines and delve into the numbers. A key metric here is the price-to-earnings ratio, or PE ratio for short, which helps us understand if a stock is priced appropriately compared to its earnings.
Okay, so for those of us who aren't walking Wall Street dictionaries, can you break down what that means in plain English?
Sure. Think of it like this. If a company is earning $1 per share and the stock price is $10, it's a PE ratio of 10. A high PE ratio often suggests that investors are expecting good growth in the future. But it can also mean the stock is priced higher than its current earnings justify, potentially making it riskier.
So applying that to Walmart, a high PE ratio would mean investors are betting on them to keep crushing it, even though their stock price has already shot up. It's like they're already baking in those future wins, which makes you wonder, well, is there much room left to grow?
Exactly. And that's what we need to figure out. The Motley Fool dives into some scenarios, looking at potential earnings growth and different PE ratios, and things get pretty interesting. We'll unpack all of that in a bit, but first let's talk about another piece of the puzzle. Walmart's status as a dividend king. For long-term investors, this is a big deal.
You're right. That Dividend King title isn't just for show. Help me understand why that's so important, especially in relation to this whole trillion-dollar question, because didn't the article also point out that Walmart's current dividend yield is actually lower than the S&P 500 average? That seems like a bit of a contradiction.
It is. It is a fascinating contradiction.
Whoa.
To clarify for our listeners, Dividend King means that Walmart has increased its dividend payout for at least 50 consecutive years. That's a very select group of companies. It demonstrates incredible stability and a commitment to sharing profits with shareholders.
Okay, that makes sense. But how do we square that with the lower than average yield? It feels like we're getting mixed signals here.
Yeah, we are. And that's why it's important to break it down. See, dividend yield is calculated by dividing the annual dividend payout by the current stock price. So even though Walmart is increasing its dividend, the yield is lower because their stock price has been skyrocketing at an even faster rate.
So it's like a seesaw. Stock price goes up, yield goes down, even if the dividend itself is increasing. So for investors, that means
It means they need to carefully consider their priorities. Are they looking for immediate income from a higher dividend yield, or are they betting on long-term growth potential, even with a lower current yield? There's no right answer. It all depends on individual investment goals and risk tolerance.
this is where things get tricky, right? We have this incredible track record of dividend increases, which is super attractive for long-term investors. But at the same time, that soaring stock price makes the yield less appealing. For those looking for more immediate returns, it's a real balancing act.
It is. And that leads us back to the trillion-dollar question. Can Walmart hit that market cap? And if so, when? The Motley Fool crunched the numbers. And what they found, yeah, it might surprise you.
Well, now you've really got me hooked. Let's dive into those scenarios and see what those projections tell us. All right, so we've established that Walmart's stock has been on like an absolute tear. Their dividend history is rock solid, but that yield is, well, kind of a head-scratcher. Let's dig into those Motley Fool projections and see what they tell us about Walmart's chances of hitting that trillion-dollar market cap.
The projections are fascinating. They highlight the tension between Walmart's current valuation and its potential for future growth. Even though they're posting record profits and demonstrating strong growth, their stock price has already surged so much that reaching a trillion-dollar market cap would require an even steeper climb, which some analysts believe might be a tall order in the short term.
So even with continued success, the question is whether that stock price can keep up the momentum. To hit that magical number, that's where those different PE ratio scenarios come in, right? The Motley Fool article mentioned those.
Exactly. Remember, the PE ratio gives us a sense of whether a stock is, overvalued or undervalued relative to its earnings. The Motley Fool explored a few different scenarios, playing with the potential earnings growth and various PE ratios. And what they found is that, even with pretty optimistic assumptions, hitting a trillion-dollar market cap in 2025 seems unlikely.
So it's not impossible, but it's a long shot for this year. That makes me wonder, what kind of PE ratio would Walmart need to reach that trillion-dollar mark? Assuming they keep up this impressive growth, do they need to become some sort of market darling with an astronomical PE ratio?
It's not necessarily about becoming a market darling, but it would require a significant shift in investor perception and expectations. Remember, a high PE ratio suggests that investors are extremely bullish on future growth prospects. To reach a trillion-dollar market cap with their current earnings, Walmart's PE ratio would need to be, well, significantly higher than it is now, implying a level of confidence in their future performance. That might not be realistic, given the competitive landscape and other factors.
This is all starting to make more sense. It's not just about Walmart performing well. It's about them exceeding expectations by a huge margin, enough to justify a massive PE ratio and drive that stock price even higher.
Precisely. And that's a tough ask for any company, even one as successful as Walmart. But remember, the Motley Fool article also pointed out that, while the timing might be uncertain, Walmart is still well-positioned to potentially be the first dividend king to achieve a trillion-dollar market cap.
That's a pretty impressive distinction, considering how few companies have managed to maintain that dividend king status for so long. What stands out to you as we look at this whole picture of Walmart's potential?
For me, it's the interplay between their legacy as a reliable dividend-paying company and their ambition to be a leader. In the rapidly changing world of retail, they're trying to be both the steady tortoise and the nimble hare, which is a difficult balance to strike.
It's almost like they have this dual identity. On one hand, they're this massive established company with a long history of rewarding shareholders. On the other hand, they're making these aggressive moves into e-commerce, AI, and other areas to compete with the likes of Amazon. It's a really interesting dynamic.
It is, and it's what makes this deep dive so compelling. We're not just looking at numbers on a spreadsheet. We're trying to understand the forces shaping a company that plays such a huge role in our everyday lives. I mean, think about it. Almost everyone has shopped at a Walmart at some point.
You're right. It's not some abstract corporation. It's a company that we interact with on a very regular basis. And that makes it even more fascinating to see how they're navigating these big shifts in the retail landscape. But of course, it's not all smooth sailing. The Motley Fool article also highlighted some potential risks and challenges that Walmart might face moving forward.
Absolutely. No company is immune to challenges, especially in an industry as dynamic as retail. And those challenges can impact not just their bottom line, but also their potential for reaching that trillion-dollar market cap.
Okay, so let's shift gears a bit and delve into those potential risks. What are some of the things that could throw a wrench? In Walmart's plans for world domination, well, we've talked about Walmart's strengths, all their wins, their ambition to hit that trillion-dollar mark. But let's get real. No company is invincible. What are some of the, stratasols that might hit on the road ahead?
You're absolutely right. Even for a giant like Walmart, the ground can shift beneath their feet. The Motley Fool article flags competition as a major factor. Amazon is still, well, the 800-pound gorilla in e-commerce. And other players like Target, they're up in their game. With online shopping and delivery options, Walmart's making moves in those areas. But it's a constant race to stay ahead.
So even with their investments in e-commerce and delivery, it's not a guaranteed win. They can't just rest on their laurels.
Exactly. They need to constantly innovate
Yeah.
and anticipate what shoppers will want next. It's not just about keeping up with Amazon. It's about predicting where the whole industry is headed.
Okay, so fierce competition is one thing. What other risks are out there?
Well, the economic climate is always a factor. Walmart has benefited from being seen as the value retailer during times of high inflation. But what if we hit a prolonged recession? People might start trading down to even cheaper options, squeezing Walmart's margins.
That makes sense. Even essential spending has its limits when budgets get really tight.
Right. And then you have external factors, like those supply chain disruptions we've all seen in recent years. Walmart's size and global network help. But they're not immune to those kinds of global hiccups.
So we've got competition breathing down their neck, economic uncertainty looming, and a global supply chain that can be a bit of a roller coaster. Any internal challenges we should be thinking about?
One that the article touches on is labor costs. Like a lot of companies, Walmart's facing pressure to raise wages and benefits, especially when finding workers is tough. Keeping employees happy while also managing costs, it's a tightrope walk.
It's a reminder that even a simple trip to the store is connected to all these bigger forces. Global economics, technology, the workforce. It's pretty mind-blowing.
What's fascinating is how all these pieces fit together.
Yeah.
For example, investing in automation and AI could help with those labor cost pressures. But then you have concerns about job displacement and the need to retrain workers. It's a complex web of interconnected issues.
It's a lot to juggle, but looking back, Walmart seems to have a decent track record of handling these kinds of challenges.
They do. And that's why, despite the risks, I wouldn't count them out. Their sheer size, their brand recognition, their ability to adapt, those are powerful advantages.
So as we wrap up this deep dive, what's the key takeaway for our listeners? What should they be mulling over as they consider Walmart's future?
I think the main thing is to remember, there's no such thing as a risk-free investment. Walmart has a lot going for it, but they face those headwinds like any company.
But as we've discussed, they've shown they can weather storms and evolve with the times.
Exactly. Whether they hit that $1 trillion mark is still a big question. But understanding the factors that will shape their journey, the good and the bad, that's what empowers you to make informed decisions. Whether you're a seasoned investor or just starting out, that knowledge is invaluable.
Well said. And that brings our deep dive to a close. We've covered a lot of ground today. Walmart's stock surge, their dividend king status, that ambitious $1 trillion goal, and of course, the challenges they face along the way.
It's been a great discussion, really unpacking the dynamics of this retail giant. I hope our listeners feel inspired to continue exploring Walmart's story and the world investing in general.
Knowledge is power, right? So stay curious, keep learning, and make those investment decisions with confidence. Until next time, happy investing.